Good morning, everybody, and welcome to part one of our virtual uranium conferences for this week. My name is Derek McPherson. I'm a Vice President Equity Research Analyst here at Red Cloud Securities. 2 weeks ago, we hosted a first uranium conference and had over 200 people participate. And with uranium continuing to run, we thought we'd expand the theme with 2 more uranium conferences this week. I have with me on the webinar today Marcelo Lopez from L2 Capital Partners, Steve Roman, Chairman, President, and CEO of Global Atomic Corporation, Mark Henderson, President and CEO of Laramide Resources, and Jeff Klenda, Chairman, President, and CEO of UR Energy. For today, the format of this webinar, Marcelo's going to give us an overview of the uranium market. Nothing like a fund manager who's been suffering through it up until now to give us some perspective on where we are. Then each presenter will give their presentations. After each presentation, there'll be about 5 minutes for questions, and we'll take questions from the audience. As a reminder, you can type your questions into the chat at any time. I would just ask for the presentation, if you're asking a question specific to a company, just note the company name in there so I can keep the questions straight. And at the end, I'm going to post a poll, and at the end of the presentation, we'll get the poll results up for everyone to see. So. Just for a matter of format and order of presentations, Marcelo will speak first, and then Stephen with Global Atomic, Mark on Laramide, and Jeff on UR Energy. Just to get the exciting part out of the way first, I'll go through the disclosures quickly. For all 3 companies, there may be some forward-looking statements made on this webinar. I would direct listeners to the cautionary note on page 2 of each company's corporate presentation, located on each company's website. For Red Cloud Securities, I would highlight this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities or a recommendation to buy or sell securities. And we note that this call does not take into account the particular situation or needs of individual investors. Investors should rely on their own investigations and seek their own professional advice before investment. For the individual company disclosures, please see our most recent research notes on the uranium market. So with that being said, I'll turn it over to Marcelo to speak on the uranium market. Marcelo, I think you might be on mute.
Marcelo, why don't you log out and log back in? And that should fix things.
Apologize for the slight technical glitch, folks. We'll get this right back on track here shortly.
Hello?
That's much better, Marcelo. Thank you.
Oh, nice one. Thank you, everyone. Thanks, Derek. And well, I'll be talking a little bit about uranium, where we were before the virus, where we are now, and what we should look for in the future. So obviously, here's a disclaimer that I strongly recommend everyone to read. Bear in mind that nothing I would say here today is a recommendation and should not be taken as such. Please do your own due diligence. Now, L2 Capital is an independent asset management company. We're based in Brazil, and our focus is on global opportunities. We created a term to define what we do, and it's crisis and opportunistic investing. Basically, we look for asymmetric investment opportunities. We invest alongside investors, so we put our money where our mouth is. And actually, the timing of this conversation is very good because we are launching an ETP next week, an exchange-traded product. It's going to be listed in Vienna, Austria, and Fundo Multimercado, which is, it's a kind of a hedge fund. It's going to be listed in Brazil. Now, uranium is a metal used to produce clean, sustainable, reliable, and cheap energy. I'm not going to be talking here about why invest in uranium because I've done it a few times in the past, but I strongly recommend whoever's interested to go to YouTube and just type Marcelo Lopez uranium. And there are many interviews I give in there. And the most obvious one is my speech at the International Uranium Conference last year in Adelaide, in which I talk about why invest in uranium and why I believe this is the chance of a lifetime. Now, where we are at today, well, demand has been increasing. We have actually modeled the demand and got to an increase of around 1.7% per annum since 2011. China is growing. It's building 6 to 8 nuclear reactors per year all the way to 2030. India is also increasing its nuclear power generation. So it's Russia, Egypt, Brazil, Argentina, and many other countries. But the growth is not only about the new nuclear reactors that are coming online, but also of the delayed shutdowns. So for instance, in France, 14 nuclear reactors that were going to be decommissioned in 2025 got an extension to 2035. So it's an extra 10 years of uranium consumption that was not on anyone's numbers. Spain's the same thing. All nuclear reactors were going to be decommissioned this year, but they got extensions to 2027 and up to 2035. And so did a few reactors in the US, Mexico, etc. Supply has been decreasing. The conversion market started becoming more disciplined in 2014, and we saw just what happened over the past couple of years when conversion went up by more than 400%. The miners started a bit later in 2016, so we were about to see a response from the market this year anyway, in my opinion. And the most interesting part of it all is that some of the sellers have now become buyers. And because of the sector has been in a bear market for so many years, very little money has been invested in developing existing resources, ramping up production, or even in CapEx. So because of this lack of investment, no new production, no new relevant mines are coming online over the next few years. And this makes sense. Why would you produce something for $40 or $50 a pound and sell it for 25 or 30? It just doesn't work. But this will add fuel to the fire when the market turns, and I believe it has. And this is important, especially in uranium. See, I'm a fund manager, and my job is to look at the current market and try to project it 1.5 years ahead to see what sort of investment I should make today. But uranium is completely different because of the long time frame between mining and the moment the few rods enter a nuclear reactor. Looking ahead 1 and even 2 years means nothing. So you have to look much, much further. And the further we look, the more interesting this market becomes. And last but not least, inventories. Now, because of the long time frame between production and consumption of uranium, it is normal that utilities maintain a high level of inventories. So 2 year plus is the norm, as it could take up to 2 years to produce the few rods. But the interesting thing is that utilities are using their inventories at the moment when they should be buying uranium. You normally use your inventories when prices are up and increase them when prices are low. And I talked to utilities, and until recently, they didn't seem to be very worried about uranium. They were looking at enrichment, at conversion, but very soon, I believe, they will look at the U3O8 market as well. So where are we in terms of after the COVID? Well, the demand remains stable. We noticed a decrease in electricity production. China was just under 5% in March. but it hasn't affected any nuclear reactors. Nuclear reactors are not something that you just flick a button and turn it on and off. It has to be programmed, it takes a long time, and it costs money. It's much easier to reduce production of a gas or a coal facility. And I spoke to the Chinese at the end of last week, and until then, there hasn't been any delays in construction of new nuclear reactors. Now, the supply side is a problem. Supply has been cut by almost half over the past month and a bit, and the impact in the sector is huge. I would like to talk about this more, but because of time constraints, I will leave it aside. But it's important to mention that Husab might be put into care and maintenance as well. The chairman actually of CGN is retiring at the end of this year, and according to Chinese law, he's going to be evaluated before he can retire. So he might be willing to put Husab into care and maintenance. And Rossing and Cigar Lake will be gone before the end of the decade anyway. And the cost to ramp up production in Kazakhstan will be much, much higher. Uzbekistan and Australia, I mentioned in here, they haven't cut production yet, but there are risks that they might do. And the importance of Australia and Uzbekistan is that most of the uranium they produce go to the spot market. And a couple of important things to mention about the spot market. One, it's a small market compared to the term contract. And two, it supplies a lot of uranium to the carry trade. So in my opinion, we are at the very end of the abundance phase. So just to explain what I mean, there are two different sentiments in the commodity market, one of abundance and one of scarcity. I actually didn't create these terms, but I call the abundance phase because until a couple of years ago, there was a sentiment of abundance of uranium and utilities grew accustomed to it. There was an overproduction because miners delayed the adjustments after Fukushima, and it was just a blue sky for utilities. So the more they postpone signing long-term contracts, the better for them. They obviously are very clever people and they took full advantage of it. And during the abundance phase, the focus is on inventories, as it is the case with every single commodity. But now we are entering the scarcity phase, where the focus changes from inventories to security of supply. And it's going to be a shocker for many people. Funny enough, when uranium or any other commodity for this matter is cheap, there's an abundance of traders willing to sell it. But when the price turns and it starts to get more expensive, the sellers disappear. And the rationale is, why would you get rid of an appreciating asset? You just can wait until tomorrow and charge more for that. And this brings me to the last bullet point on this slide that talks about deficit. Now, the primary deficit should jump, and with almost half of the world's production suspended, utilities will go back to reassess this market in two levels. One, the carry trade is going to suffer a lot. It normally works when long-term contracts are $32, $33, and the spot is $24, $25. But now above 30, when spot market above 30, it's going to be very difficult to find the material. And number two, inventories are at a very low level in the cycle, and utilities now will look we'll look at the most important thing for them, which is security of supply. Chemical announced that it was putting Cigar Lake into care and maintenance to protect their workers and their families. But the decision to bring it back online was going to be a commercial decision. So on the next slide, we're going to discuss what we should look for. And the first thing is the restart of mines. So we'll pay close attention to the reopening of the mines, how they're going to ramp up production, if they face any difficulties, etc. The other point I would like to make is to look for the spot price. Whilst we haven't seen any material long-term contracts being signed, this is going to lead the way. Remember, now we have traders, utilities, and miners competing in this market to buy those pounds. We are also seeing the spot market go up, SWOOS going up, conversion going up. So the next thing is the long-term contracts. There are many discussions going on at the moment, and we should start seeing relevant long-term contracts being signed towards the end of this year. And I doubt the price is going to be $32. And another important point I would like to make is about portfolio management. We are living in unprecedented times, and as a portfolio manager, I look for uncorrelated assets that are able not only to protect the portfolio, but also to bring nice returns to my investors. And uranium fits this narrative beautifully. So from 2011 to 2018, every single asset class in the world went up. And I mean, stocks, bonds, real estate, commodities in general, art, cryptocurrencies, you name it. But uranium. Now, comes 2018, everything crashed down and uranium went up by almost 30%. Now, last year, again, everything went up but uranium. And this year, needless to say, everything crashed but uranium. And people are noticing it more and more is being written and talked about uranium in this market. And because it is a very small market, the price adjustments tend to be more pronounced. So look for it. And one point that I believe many people have forgotten is the Nuclear Fuel Working Group. This was the most important event at the end of last year and in the beginning of this year, but now no one talks about it anymore. But it's still there, and the outcome might be very positive for miners. There's already a provision in the budget for the Department of Energy to buy $150 million of uranium per year for the next 10 years. So it's $1.5 billion invested in uranium. Well, we still don't know the details, but again, this is very good news. And last but not least, and I don't want to spend too much time talking about it because it's pure speculation. We have the Russian suspension agreement and the Iran sanctions, which are up in the air, possess a risk to the buyers. But this is important because it shows utilities how important security of supply really is. So that's it from me. Again, I would like to thank you all for your time and thank Red Cloud for the invitation.
Thank you, Marcelo. A couple questions from the audience. First, I guess with this turn, and I guess spot price has been on a bit of a run since I guess March 23rd, the day that Cigar Lake's closure was announced. Have you seen any new money coming into the space, new investors, or new new money flowing into L2 for uranium?
Absolutely, yeah. A lot of new investors. We follow it even on Twitter and the level of questions there. And there was a lot of demand from new investors and existing investors in our fund in the turn of the month of the quarter.
Right. Yeah, I think that's it's
expected.
It's expected. It's certainly something we've seen, especially for an asset class that's has a historic volatile returns, and both positively and negatively, but also one that's been so under pressure, and as you noted, uncorrelated.
Yeah, and Derek, I think people remember what happened in the last bull market of uranium when prices just went up to almost $140, and the returns they made investing in stocks. So now that the spot price crossed the psychological $30 barrier, I think more and more attention has been drawn to the sector. Just last week, there was an article in the Financial Times on Bloomberg was talking more about uranium, and also Reuters. So they are all picking up on this story.
It's what usually when it hits the mainstream media, we all get a little bit worried, though, right? I guess a question from the audience, a little bit. This will probably be a little bit technical, but maybe can you explain the mechanics of the carry trade and why it's stopped, and why it's so important that it has stopped, and what that means for utilities?
Sure. Well, it's basically when a utility wants to buy uranium for delivery in the future, and they do it through a trader who buys the uranium in the spot market and carry it in its book for a few years, maybe 2, 3, even 4. And they charge utilities storage, interest, etc. And the carry trade is a very important part of this market. It's not a big part, but it's a very important part because the utilities managed to get uranium for 2, 3, 4 years. They preserve their balance sheet. If you talk to utilities, you will understand that the most important thing for them is working capital. So if they can pay a little bit more in the future, but save the money now, their metrics will be better and they will make more money. And because of the carry trade, the utilities were able to postpone signing long-term contracts. But now this is coming to an end. Or at least it's going to be reduced dramatically.
Right. Well, I guess there isn't the profit anymore for the traders to hold it.
There you go.
Which is the key part, and traders are like portfolio managers; they're in it to make money. This is a question about I guess tradable or liquid inventories, and I think this will be the last one on the market. The question is, do you think that the tradable uranium inventory could get reduced to almost zero this year?
Well, it's difficult. I mean, a lot of the uranium that's traded comes from Uzbekistan and Australia, and none of these markets have been shut down so far. They're still producing. They're producing less, maybe, but they're still producing. Now you have to bear in mind that Chemical will have to buy pounds this year. They have to buy around 20 million pounds, a bit more now that they shut down Cigar Lake, and well, they put Cigar Lake into care and maintenance, and Inkai was also suspended. But remember, Orano as well will have to go to the spot market, because Orano lost Cigar Lake, they lost MacArthur River, they lost Kazakhstan, and they still have to repay Chemical for the 5.1 million pounds that Chemical lent to them just after they shut down MacArthur River. They have until the end of 2023. It's not tomorrow, but still, it's 5.1 million pounds that that needs to be repaid somehow. Maybe in the spot market, maybe with production. We don't know. So I'm not sure whether this market can dry up 100%, but it will definitely be reduced. Listen, it's not a big market. The spot market it's a market mostly for traders who are shifting inventory from one to another and making 25 cents, 50 cents every time they do it. And the opportunity is just not there anymore. So I believe traders will start to hold on to their inventory because, again, it's an appreciating asset.
Right. Okay. And then I can't let a fund manager off the phone without asking this question. And this one is from the audience, wasn't from me. But what are some of your top picks right now in the uranium space?
Oh, Derek, I'm so sorry to disappoint you, but we don't disclose any of our positions. But I have talked about a few of those when I did the podcasts. But please feel free to go into the L2 Capital website. It's l2capital.com.br. And we have done a few podcasts there. And if we interview a company in which we own a position, we normally make the disclaimer in the beginning of the conversation. Sorry about that.
No problem. I have to ask. And with that, Marcelo, thank you very much. Apologize to everyone else who asked questions. We just got to keep things moving here on the uranium market. So thank you very much, and thank you for staying up so late. Just for our audience members, Marcelo's in Sydney, so it is about 12:30 tomorrow there for him. So thank you very much for your time.
Thanks for having me. You guys have a good day.
So with that, we'll turn it over to Steve Roman, Chairman, President, and CEO of Global Atomic. Josh, presentation over to you.
Good morning, everyone, or good evening, whichever the case may be. Nice to be here today. Global Atomic is a company I started in 2005. We've got two divisions. One is a base metal zinc division, and the other is a uranium division. Typical disclaimer, as the previous gentleman said, do your own due diligence. So company overview, the uranium development is underpinned by cash flow from zinc production. So we have a zinc asset in Turkey that's producing profitably since 2009. It gives us a lot of flexibility. Our big asset is the Dasa uranium deposit in Niger. We discovered that deposit in the end of 2010. We had a lot of support from institutions like JP Morgan, Macquarie's, Investec that supplied us with capital. We were a private company at the time, and we really moved that discovery along to the point we are today. We're in the feasibility process. The zinc asset in Iskenderun, Turkey, we just built a new kiln there. It's a new plant that will process 110,000 tons per year of electric arc furnace dust. And currently our market cap actually is moved up a bit over the last few days. I think we're somewhere between 80 and 90 million at the moment. Our shareholder structure, we've got 145 million out, about 160 million fully diluted. Currently, again, market cap has moved up during this good uranium market we're experiencing. End of the year, we had 3.8 million in cash on the books. Right now, we're probably around the 3 million mark. Our share price has moved up to about 60 cents. So I'm the biggest shareholder of the company. I've continued to purchase shares. One of my ex-partners, Mr. Clifford Frame, also from Denison, him and his family own about 7%. Sachem Cove out of New York is about 7%, and our partners in Turkey, Befesa, have about 4%. We have a fund, Hargrave Hales in the UK, now part of Canaccord, with about 4%, Deutsche Rohstoff at 3%, and others at 66%. This was basically a retail story initially, and now a number of new funds have been getting into the story. I put together a good team of people. My days at Denison Mines allowed me to meet a lot of people in the uranium field. Myself, my associate George Flack, him and I have been working together in West Africa since the mid-80s. And George is the one that opened up the doors for us to enter Niger and negotiate 6 permits in that country back in 2007. Paul Cronin, Richard Fauché, Derek Rance, and Asier, you can read all their bios there, all very experienced in the mining space or zinc production. We just hired a new COO, Mr. Ron Hallis. He was previously running Kinross's operations in West Africa and Mauritania, the Tasiast mine. Merlin Mar Johnson's based in the UK. He's a geo and former fund manager and analyst. Rain Lahari, our CFO, very experienced, former PricewaterhouseCoopers. Fergus Kerr came from the Denison camp. He was the mine manager at our Elliott Lake operations. Peter Wollenberg was out of Areva. He was the head of their North American exploration, and Tim Campbell, our corporate secretary, very experienced in that field. So our uranium projects in Niger, we just put out a new PEA for the Dasa project. We spent 2019 basically doing trade-off studies on how best to mine that deposit. And so what we did is we focused in on an underground ramp access mine targeting an area that we actually developed through cash flow coming from our Turkish operations. So we didn't dilute the company at all during that phase, during 2018, 2019. And we discovered and developed a brand new area of the deposit that will give us a very robust phase 1 mine plan. So the highlights of the PEA, NPV 8, post-tax $211 million US. That's using a a base case price of $35 a pound. We thought we'd be realistic with our numbers, and I think $35 is quite achievable by the time this mine enters production. You can see the IRR, the initial capex, which includes a 20% contingency plan, and our payback based on all of that. So this phase one gives us a 12-year mine life at an average grade of about 0.5% U3O8, 5,396 ppm, doing about 4.4 million pounds a year, and total production through that phase one of 44 million pounds. Cash costs are quite low at $16.72, and our AISC costs $18.39. That's all related to mining a few tons at a very good grade. So basically, you can see the numbers here with our base case at $35 a pound. Should uranium move up a little bit higher, or we can sign longer term contracts, you can see the numbers there. We gave everybody sensitivities on these things. We can even make money if it goes down to $25 a pound, but I think those days are behind us, hopefully, at this point. And you can see the economic sensitivities here. We used NPV 8. Some people like using higher discounts based on West Africa, but I think that's realistic and what people are generally using these days. So this is a longitudinal section of the Dasa deposit as it currently sits over a strike length of a couple of kilometers. It's in a graben. It's a graben-hosted sandstone deposit. And so you can see the flank zone area up near the top. It's about 70 meters below surface. So, you know, that's why this initially looked like a potentially good open pit, but there would have been sufficient stripping there to delay the project by a couple of years and costing too much capital. So we decided to target that area because it's very high grade and close to surface, just with a ramp and cut and fill mining with backfilling. We can extract 100% of that material. That gets us down into the lower levels, which we would develop over the years and, you know, have a very long mine life here. It just shows you the mine plan. We're showing August 2023 as sort of a start time for this. And you can see how it develops that flank zone only area over the years and how we take out that material. So Dasa, the reason we're there and in Niger, we're very familiar with the Canadian operations and the permitting timelines for operations in Canada. So we decided to go to West Africa, and Niger at the time, 2005, was just opening the doors for foreign investment. And so we got in there early days and made some deals with the government on 6 permits. And we have 4 deposits in the company, Tinigaran, the Isikanen, the Daji, and the Dasa. The Dasa is our latest discovery at the end of 2010, as I mentioned. And the infrastructure is good there. We're on the main highway between Agadez and Arlit. Orano's mines, Somer and Komanak, are in Arlit, about 100 kilometers north of us. We're right on the power grid as well. So you couldn't ask for a better location in a very uranium-friendly jurisdiction. Permitting timelines here, typically 4 to 6 months once you submit your feasibility study and your environmental impact statement. So as I just mentioned, you know, we are in a uranium country. They're 4th or 5th largest, well, here we're saying they're 4th largest global uranium producer. That goes up and down depending on production from a couple of other places, but generally speaking, in the 4 or 5 range. uranium's been mined there for 50 years. Orano, ex-Areva, has been mining the Somer and Cominac mines for decades. And so it's a very important commodity for the country. It's the bulk of their foreign exchange. And there's never been an issue through that whole operation piece that Areva, Orano have been working there, where there's been any kind of stoppage due to government activity or nationalization or any of those kinds of things. So it's been very, very solid, steady supplier of uranium for 50 years. So what we've achieved in 13 years, we have 6 licenses, 4 discoveries, 1 MOU. We signed an MOU with Orano in July of 2017 to supply a minimum of 100,000 tons a year to either Cominac or Somer. We are discussing with them how this would proceed, subsequent to us putting out some numbers and seeing what the capex and production and grades will be. So they've been in discussions with us since then and doing test work and helping us with various things in country as far as metallurgical testing, running samples through their mill, etc. So we expect that that we have a potential to ship them ore as well as produce our own with our own facility. You can see some of the deposits there and their size. Clearly, DASA is the outstanding deposit at greater than 250 million pounds, and you'll see some of the grades coming up here. So here they are. It's a large, high-grade strategic asset. So at varying cutoff grades, we're using basically a 2,500 ppm cutoff for this phase 1. You can see, that still gives us over 100 million pounds. And the grades are between 6,000 and 7,000 ppm. So this is very significant for an African uranium project. I don't think I've seen any like this in Africa and decades. So this is a fabulous discovery, and we're moving it ahead. A little bit on our Turkish operation. So here's a shot of our new plant, our new kiln. This is a 56-meter long kiln. And we actually have 8 steel mills around us. These are electric arc steel mills, and they produce a waste product called electric arc furnace dust. And we initially had 100% of this project. We acquired a shut down old plant in 2008 during the financial crisis. We fixed it up, put it back into production. A year or two later, we brought in the best in the business, Befesa Zinc out of Spain. We sold them 51% and allowed them to come in as operator because this is their core business. So we have a 49% interest, a very good working relationship. We meet monthly, and the new plant basically built entirely during 2019. So we shut the old one down in end of January, and for 7 to 8 months we knocked down the old plant, built the new plant, and commissioned it at the end of 2019. So it is running now, and we're tuning it up. Zinc prices unfortunately have dropped from about $1.10 to about 85 cents now. We still are able to make money at 85 cents a pound. But clearly, what we're telling people now is rather than a 1-year payout on this asset, it'll probably be a 2-year payout due to COVID-19 and lower zinc prices. So Turkey, for the audience here, they're the world's 8th largest steel producer, and most of their steel production comes from electric arc mills. So that's the type of mill that supplies us with our feedstock. And it's like having a high grade zinc ore body that's perpetual as long as the steel industry keeps running. We're basically treating zinc ores through our plant that are running between 25 and 30% zinc. So we produce a 70% zinc concentrate, and we ship that material from our own port facility that we share with the steel mills to Europe in containers. And our biggest customers are Glencore and Nearterm. So this is a sustainable feedstock, and you'll see here there's different clusters of steel mills in the country. We're in the Mediterranean region where they have 16.7 million tons of crude steel capacity. So we're really in the biggest area for steel production, and we're right on the water there, as you can see. So great for shipping logistics. So the new kiln doubled our capacity, and you can see here previous was 60,000 tons per annum, doing about 33 million pounds, attributed to us about US 10 million annually. Now the expansion, of course, has bumped that up to 110,000 ton capacity, and should the markets return to normal, our US 10 million would go up commensurate with the zinc price. So our near-term catalysts, we've put out a robust PEA right now, and the idea that we have on our schedule is that this PEA, a lot of it done to PFS level. We're moving that through to a final technical report, as we're calling it, to submit to the government for our application for a mining permit. We are in the midst of also completing our environmental impact statement. So that's all going to be submitted by July, August this year. And, the government will take 3 or 4 months to review the material, and we expect that they would issue our license sometime by Q2 next year. So once we get that license, we'd finish up some geotechnical drilling and any other engineering we need to do, and of course financing for developing and building our own project, and moving this through to construction phase, probably starting in 2022. Typically, I would say it would take 18 to 24 months to build a new project. So that would put our production from our own plant probably into conservatively 2024. We may be able to speed that up if we can start delivering ore to Orano. So that's a big unknown at the moment. We know that they've been discussing with us the amounts of ores they want, but we haven't nailed down a price yet with them. So, clearly, I think with our numbers, it's in our favor to move forward as a standalone operation. And the Orano deal could be a value opportunity. So you can see there on the lower part, the BST project, basically, as I mentioned, retirement of that debt rather than 1 year, we think could be 2 years now with the price of zinc. But that'll be a very solid cash flowing business for us for many years to come. So that's the recap there. Strategic uranium backed by positive cash flow. So I'm not going to read all of these things, but I think everybody gets the message. And I think we're a little bit unusual for a uranium company in that we do have a cash flow base and a very significant high-grade uranium asset. Supply and demand, we heard about that, and thank you very much, everybody. That's my presentation.
Thank you very much. Thank you very much, Stephen. Maybe we'll go to a couple of questions from the audience. And I think you touched on this a little bit at the end there, but maybe what do you think your your competitive advantages versus sort of other African uranium plays?
Well, I would think the biggest competitive advantage, we have a couple. One is location, because we have all of our infrastructure there. And number two is grade. So the grade is Athabasca style uranium grades. We have, and you'll see in the press release we put out, the PEA and the flank zone area. Out of those 44 million pounds, about just over 30 million pounds of that is running at over 1% uranium. So it just stands out compared to any other African uranium project.
Right. And then with the PEA, a question from the audience: did you consider any other extraction methods such as ISR for the project?
Yes, we didn't do any ISR testing, but based on the geology there, with ISR you need an impermeable base and an impermeable cap, and you have to be able to put those acidizing fluids into that sandstone. We don't have such a thing from our investigations at DASA. It's a large, thick ore body, as you could see in that longitudinal section, and we find it's much better mined with better recoveries just by standard underground mining methods or open pit, if you have the capital to do a big open pit. We didn't want to flood the market with uranium. We thought we'd focus on a project that would produce 4 to 5 million pounds a year. Obviously, if you were Rio Tinto, you might mine this in a different way and just have a big open pit.
Yeah, it's also easier to execute on a smaller scale, right?
That's right.
And then just last question from the audience. A couple of questions on the JV in Turkey. Other than obviously the lower zinc price, is there any other impacts on that operation because of COVID-19?
Well, right now, Turkey, of course, has been affected with COVID-19. Our operations are running. We do have a very strict protocol there. The good thing about our new plant, it's very automated. So compared to the old plant, all the systems are automated. You don't need a lot of human intervention. So we're using sort of a rotation process now and keeping people at a distance from one another and really following a very strict protocol.
And is there any impact on your, for lack of a better term, your suppliers and the steel mills? Have they seen any process interruptions?
Yeah, well, not interruptions, but of course, with everybody stopping work, the steel demand has come down. So. Right. I would say when we started the project, the mills were running at about 80% capacity. Mm-hmm. They're probably running at about 60% capacity right now. So, we hope that after COVID is over, that things continue to ramp back up to where they were and we have adequate supplies of dust. But I would say this year, although we can handle 110,000 tons a year, this year coming up, in 2020, I would think that we'd probably be down to 60 or 70,000 tons of process capacity.
Okay. All right. Well, I know from my past experience as a steelmaker, I know that Turkish steel mills are some of the lowest costs in the world, so they'll be the first. I suspect they'll be some of the first to come back. With that, I think we'll move on to the next presenter. Thank you very much for your time this morning, Stephen.
My pleasure. My pleasure. Thanks, Derek.
So moving on to our next presenter is Mark Henderson, President CEO of Laramide Resources. And Mark, we'll turn it over to you.
Yeah, very good. Thank you, Derek. I hope everyone can hear me. Thank you for the opportunity to talk to you this morning about Laramide. It's an exciting time, I think, for the uranium sector after a long period that wasn't quite so exciting. So the title of this presentation is Diversified Uranium Developer in an Emerging Development Environment. And I think this latter statement is really something that you only could have said, frankly, with any confidence, probably in the last 2 or 3 weeks is I think we are finally seeing the end of the bear market that for any of you that have been unfortunately in the space for a long period of time, it's probably gone on a lot longer than any of us thought. Many of us thought after Fukushima it was sort of a 12 to 18 month in the penalty box event, and obviously it's gone on a lot longer, but I do feel that we're through the end of that now, and we're getting into some pretty interesting times. So with that, we've seen everyone's disclaimers already. Ours is similar. The overview is really we're a diversified uranium developer. That was by design. We wanted to build the company really to be a supplier of choice to the nuclear utility industry. And for that, you really want to have probably multiple projects in multiple jurisdictions. Some of these jurisdictions for Western uranium nuclear utilities and things like that, they tend to be quite picky about that. And they also tend to want to, when they're putting a book in a traditional sense together, and we speak about this a little later, in terms of the way the contracting market has evolved, they typically would like to see if they built a big book of supply over a long period of time, they typically want to diversify their book by projects and also by jurisdiction. So our projects were also all selected for their degree of technical risk and where they sit on the cost curve. Having said that, I think with the way the market is developing and the way I think you'll understand in terms of where demand is out over the next 10 or 20 years, basically any developer, I think, that's survived and is still the developer in the uranium business. All of these projects that you're hearing about today and many others that are in the probably 20 or 25 companies that are left in this space, my personal view is that all of these things will get developed over the next 10 or 15 years in some logical sequences. They're frankly all probably required to fuel the reactors that we have and the reactors that are going to get built. So I don't want to cover the same ground as Marcelo, but just a quick overview of kind of where we've been in the space. For those of you that don't know the space that well, we had in the past 15 years, I mean, the uranium tends to be very lumpy. It's a very small business. You know, I can't use today's oil price, of course, but when oil was $40, $50, you know, the whole global dollar value of uranium production was probably 18 hours of oil supply. So that gives you kind of a sense of scale. And that has led to very lumpy kind of performance of the commodity over a long period of time. And you can see we had kind of a super spike about 10 years ago. And some people like Rick Rule and so forth are suggesting that we may be getting into that kind of environment now. And certainly folks from that era are around and knowledgeable about what happened then. And I think see the possibilities for 2x, 3x and more. We then had a recovery basically post the GFC that was really based on China building inventory ahead of all the build that they'd done, because they went from really no power plants to a target of 60 gig in 2020, and they've come very close to hitting that target. And then what caused the 9-year bear market was really the same factors that you're now seeing in oil today, which is demand shock, a serious demand shock, which was Japan turning off all of their plants literally overnight, and they were 10% of the market, combined with a supply shock. And the supply shock was Kazakhstan, which basically had geared up to supply China, never dialed back the production increase. So you basically had those two things layered over top of one another, just like you have now kind of developing in oil, although hopefully in oil it's going to be shorter than what we had to go through. You can see at the very end of that chart that we're now it's because of the scale of this, we're starting to see the market come out of this now. We're now, we've gone from $24 to $33 in a very short period of time. And I think probably we're headed to a pricing environment very quickly that's in the $35, $40 range. And then we may see a little bit of my personal view is we may see a little bit of a pause, because there obviously are some supplies that can come back online. There's also a contracting scenario that develops where things like MacArthur get recontracted, and obviously they have a lot of resource. In terms of where we're going, the big takeaway from uranium versus really a lot of other commodities, and certainly anything else in the energy space, is that the demand is not GDP correlated. And so the outlook, and this is the outlook from the World Nuclear Association that they gave last fall in 2019 at their annual convention. They do a biannual market report. And the 2019 market report was the first time in many years where they had all three of their cases basically on this kind of rising slope where demand was headed higher over any reference case that they chose to use. And if you use the middle case, we end up with a plus 2%, compound annual growth rate of demand out to 2040, and that certainly encompasses all of these developers that we know today. And so obviously that's a very positive dynamic, and I think you're seeing that manifested in what's happened with this whole COVID thing, where they virtually shut down the world economy. Really, the last things to turn off virtually anywhere will be nuclear power plants. The only country that I can think of really that probably has maybe some excess capacity if their GDP or their electricity demand was down 20% or more is France. In a place like China, you're really only up to something like 5% of their electricity today being generated by nuclear. So obviously, and they're still building plants, and by and large, they've seen very little disruption with the plants underway that are being built. So the demand side of this is very positive, and so really now it's the focus on all of this is really to focus on supply. And I think that that analysis will lead you to wherever you want on price, but I think it's very hard to now create a scenario where price goes down. And obviously, we as a developer, we couldn't do anything in the pricing environment we had for virtually most of the last 9 years, and we're starting to get into a place where that is going to be possible. And the question now is going to be, when this future supply comes online, where is it going to come from? And as you can see from this slide, the uranium supply is very concentrated. So the top 5 countries produce the lion's share of it. And the real gorilla in the market, obviously, is Kazakhstan. That went essentially from 10 million pounds to 60 million. They sort of peaked out at 60 million pounds. They've now dialed back a little bit voluntarily. And then as a result of COVID, they've sort of done a 3-month shut in. But they'll still be producing something on the order of 50 million pounds in a market that needs about 180. So there's kind of a natural upper limit for how much the world can rely on Kazakhstan in any event. The other thing you have to consider is, Kazakhstan geographically is situated between China and Russia. Both of those parties actually need their supply. So in a market that gets tight, the real question is if there's surplus pounds around, even from Kazakhstan, where those pounds are going to end up. So it's pretty obvious that we're going to need new supply from various places. And we've sort of put up the top 5 and the next 5. And we think, obviously, we sort of have a foot in both camp. We have major assets in Australia, and we also have assets in the United States. And you can see the United States at 1%, they clearly have a security of supply problem. And so that has obviously been acknowledged by the Trump administration. They've been trying to do something about it. The industry has been trying to do something about it. We'll speak to that a little bit later, whether we get anything out of that now. We were very close to getting something that looked very specific, but we'll see. Obviously, it's not a super high priority at the moment. And high prices may cure the problem in any event. In terms of our asset base, we're kind of equally split between assets in the United States, which are ISR assets, and assets in Australia, which include a big development project called Westmoreland and a big greenfield project that adjoins it called Murphy. Both of these historically were Rio Tinto assets that we managed to acquire over different periods of time. The asset of most near-term interest is probably our ISR asset in the United States called Church Rock. There's a picture of it. The actual project itself sits right below that mesa on the flats. It's an asset that was drilled out in the last phase of the uranium boom in the 70s by a division of General Electric. It's a very large scale asset. We think it's probably one of the best ISRs, if not the best ISR in America, not owned by Cameco. It's 50 plus million pounds. It's got very good grade. It lends itself obviously to production at some scale, starting at 1 million pounds a year and ultimately going to 3 million pounds a year. We were the royalty holder on this asset back from 2008. And over the course of the bear market, we basically acquired the asset from a company called UI, which owned it and had done an awful lot of work on it, including getting it licensed through the federal government of the United States with what's called an NRC license, which is obviously not easy to get. We had that license transferred to us in a process that took 6 months or more. We now need one state permit basically to go out and build that project, and we're in the process of trying to get that final permit in place. Obviously, this is still an asset, even though we think this is obviously a low capex. Probably it's capex of 20 to 30 million to start. That's without a plant, without a process plant. The process plant comes in phase 2, and an op cost probably sub $20. It still requires realistically for returns to shareholders a market that's really in the $40 plus range. And I think anybody that's doing anything in development, even the folks that have projects that work on a spreadsheet at $20 if you're at the basket or whatever, realistically, I don't think anyone's going to put projects in production unless we see an environment that's in the $40 to $45 and higher. I think in the last cycle, we got to a place where the utilities kind of acknowledged that they begrudgingly would be happy with a $50 kind of floor price environment in order to get uranium supply. And I think all those years with post-Fukushima have kind of withered that away. So we're going to get a test now of how quickly the utilities are going to be willing to pay the real price to bring the next generation of supply online. There's a peer group kind of comp, just shows where our project sits vis-a-vis grade and scale and what have you. In terms of value, in a bear market, everything kind of goes to where it sort of trades at an asset level. Pounds in the ground, we got to, I think, a number like on our company is something like 25 cents a pound in the ground. Vis-a-vis, you were multiple dollars a pound in the ground before. Obviously, there's lots of room for the valuation to recover. Our other project was really the project we had in the last cycle. It's a very large open pit project in the northern part of Australia. It's 50 plus million pounds. As I said, it's an ex-Rio Tinto project. It's a open pit with about a 2-to-1 strip, very high recoveries. Again, probably low cash costs. This is a different challenge in terms of being a developer. It's a much higher capex project. Capex probably on the order of 300 million. The original idea back when we had a kind of a traditional market with utility contracting would underpin probably half the pounds coming out of the initial phase of the project, and then you'd get debt financing, and then you get equity financing on top of that. That may still be possible, as we'll touch on a little bit later. The contracting market is probably that we're going to come into hopefully soon is probably not the same that it looked 10 years ago, just because the nature of the players and the nature of what's happened and the nature of who is kind of in favor of nuclear power and who's not. So we'll probably get to a little different environment in terms of the way that project gets developed. Australia does have a number of projects that are kind of in the, I wouldn't say shovel ready, but almost shovel ready, things that are permitted. Cameco owns a couple of those that have some scale. So there is a potential for supply to kind of logically come on as we get to sort of $50, $60. And I think you'll see Australia be a bigger factor in the next wave of projects that come online. In terms of location, that's where it is. We're about 50 miles south of the Gulf of Carpentaria. It's 17 degrees south. Australia is a great jurisdiction. They produce lots of uranium. The political situation at state level is on and off. It's kind of off at the moment because of the politics. There's an election in the fall. We were in a scenario in 2012 to 2015 where the politics were on, but the price was off. We think we'll get to a place where this project will be able to be built. We have the full support of the Aboriginal groups in the area, which is key in these kind of projects. It's a remote project. It'll be a fly-in, fly-out project like virtually every mine in Australia and in most places. So it's a very good project. We're very excited actually about the asset to the west, which is a huge greenfield project that Rio Tinto basically acquired but never took to permits. We got in a JV with them in 2011, took it to permits, started to do some exploration, did some airborne. It's got the potential essentially to find another Westmoreland, which would obviously be very exciting. And then we obviously control the entire district, which is also something that, is as a developer is a nice thing to have. A little bit of an overview on the cap structure. We've got 165 million shares now. We've probably doubled the cap structure since Fukushima. So we've tried to keep it as tight as possible. It's well owned. There's some big chunky players that own it, including myself, and the insiders own more than 10%. We've got a few hedge funds and what have you, and we're starting to see now bigger changes in the register with respect to uranium-focused folks either being at hedge funds or small funds, or now we've got a few new ETFs coming up. We're in at a minor component of most of these new ETFs, the way they're created. There's obviously room to increase that as the market cap kind of moves up. The ETFs really haven't been a factor much in uranium. The one ETF that everyone kind of acknowledges was a bit of a fizzle. Got created and wasn't around in the last cycle. So we really haven't had a cycle where we've had ETF participation, where you had easy ways for the public to kind of come in and buy the sector. And so I think that'll be an interesting dynamic that we'll see develop here as this thing gets rolling in terms of this cycle. In terms of things to look forward to that really can drive the valuation of ourselves and probably some of the other peer group companies. Obviously, the uranium price, more so than in any other commodity almost, you really need the uranium price to certainly be at a level that makes sense. But also the stocks seem to be super highly attuned to changes in the spot price and what have you. Certainly that was the case in the last bull cycle. I don't think this is going to be any different. I think the levels at which people get excited and the public gets excited and we see lots of interest is going to be substantially lower. I don't think we're going to have to go to $50 before we see that happen. But it will require sort of the uranium market kind of to keep moving and for people to start paying attention to it. I think that'll be the number one thing that drives a lot of the value. Certainly near term, certainly until we get to a price level where people start to say, the market's $50. Is your project going to move ahead vis-a-vis someone else's project? The other thing, and we only just touched on it briefly, is this whole thing in the United States with what Trump did, which started with this. I don't want to go into the minutia of it, but there was a application made by a couple of uranium companies, including Jeff's company. He'll probably talk about it some more coming up, where they were asking for specific things. That kind of morphed into a broader assessment by the administration into all things nuclear by this thing called the Nuclear Fuel Working Group. They actually had managed to put something in next year's budget, which would have been very favorable to U.S. domiciled assets, which would have been able to probably benefit from nicely priced contracts to the tune of $1.5 billion a year over 10 years. Remains to be seen if that happens. Would obviously be an incremental bullish thing for us if that were to happen. We sort of don't need that. I mean, at $40, we start to get very excited about trying to get this thing, the Church Rock, up and running. But obviously, if the Department of Defense is going to hand out $50, $60 contracts, you want to be, and you're one of the few folks that can bid into that process. You want to take advantage of that. So the other thing we need to do this year, and really will be the highlight, is because of the provenance of this project, and because it was developed by an American company that never had to adhere to either the JORC regime or the 43101 regime we have in Canada, they managed to put all this asset together really without doing a resource on the whole thing or doing the economics. We've done the resource now, which gives you 50+ million pounds. We've got to do the economics and put that together and show how that unfolds for investors. Roscoe Postal did the resource. They'll do I'm sure we'll do the economics as well. And that'll be something that will happen in the latter half of this year. So people will be able to put a better sense of what the NAV value is of this project. So I think that's an important thing. And the other thing is when we get to various price levels, we have another asset I didn't talk about at all, a small underground asset that can feed into Energy Fuels' mill. We need price levels to start to get visibility on those things, but that would be another thing that could happen very, very quickly because that is permitted. And finally, we want to start up when we're allowed to in Australia with respect to the Murphy project. And so that essentially is the overview of Laramide. Happy to take any questions.
Sure. Thanks, Mark. Just a couple of questions for the line on your credit facility. Maybe can you describe how much is drawn, and then and how that and the structure of that, and who the holders are?
Sure, Derek. Yeah, it's not really a credit facility. It's a convertible loan. I mean, that facility morphed from. It actually was originally owned by Anglo Pacific, a royalty company, and then we kind of brought another party in to take it off their hands. Then over time, it became a convertible. So now it's a convertible at 7% coupon with now a 40-cent conversion price. We just went through a process where we lowered the conversion price from 60 to 40 in connection with the financing we did in December. And we sort of made it covenant light through that process. So really, I think it's now due at the end of or the first quarter of 2023. And really, we got to pay the interest cost, and it's convertible at 40 cents. And so I think in terms of debt that you don't really worry too much about, or that will probably get refinanced here in a better environment. I think it's sort of moved into that position, whereas before I think people look at it and might have said it was a barrier to owning the equity. I don't think that's really the case. We also have the other thing we have, I didn't talk too much on the cap structure or anything, but we have an awful lot of warrants. Some of them are already in the money as a result of the financing we did in the fall. There's 2 sets of warrants at 45 cents that bring in a lot of money. So that would bring in all the money we need, basically pre-construction money for Church Rock, without raising any further financing.
Okay. Well, that could definitely be helpful. And then just lastly, with respect to the COVID-19 and the impact, is that impacting any of your permitting timelines or the completion of the PEA?
In terms of getting on the ground, I think we're waiting to be able to get on the ground, in both the USA and Australia. I think it's probably more likely to impact our ability to get on this ground in Australia longer. They're being very cautious about it. It's, we're in an area where, when we work, we have to have Aboriginal monitors and things like that. They're very concerned about Aboriginal communities, as they are here in Canada. And so I do think, it's hard to put a timeline on that. And our hope is that we're going to be on the ground. And there's also a seasonal aspect of working there, especially exploration wise. I mean, obviously operationally you can work year round in Australia, but when you're doing exploration, you typically want to be there kind of May to November. And so, the season's going to open up shortly. And so we're hopeful we can get on the ground there, but that would really be the only limitation. I don't expect any difficulty at some point in time being able to do what you need to do in New Mexico. I mean, the government offices and what have you, obviously now, and things like that are all closed for the moment, but they're still working. And most of these government folks are still interacting with you and what have you. They're just doing it, in a remote way. So it may not be as efficient as it was before, but they're still operable.
All right. And what about and can you give us a little more color on the timing of the PEA for Church Rock?
The sequence is we have to drill some holes there because we need to, because of the nature of the way the resource came together, even though there's really quite tight spacing on everything and there's 1,700 holes, I'm going to say, and it's millions of feet of drilling. Because it was all done by previous folks, you can't use that in a 43-101 or kind of JORC environment. So and this happened to us in Australia. We bought Rio Tinto's data set, which was a fabulous data set, and we probably drilled 5% more holes and turned the whole thing into indicated. So that's kind of what we need to do with that project. And then that also gives us, we also need some core in order to do the final permit thing we need to do, which is around restoration or aquifer restoration in New Mexico. So we need to go in and drill for a couple of reasons, but in terms of doing the PEA, we want to do it off an indicated or primarily an indicated resource, which we think most of the 50 plus million pounds is going to convert to indicated with really quite a small amount of drilling, but we need to do that drilling first. So the sequence is do that, get the results, authorize the PEA. It's not it shouldn't be a long process to do the PEA. I mean, the nature of these, Jeff can probably going to speak about ISR a little more in America. The nature of what you do there with creating a well field and producing and what have you, it's fairly well established. There's lots of people that know how to do that. That's why you can, to some degree, you can benchmark your costs around it based on, depth to the aquifer and things like that. So, but people want to see a number. I mean, people do want to, I think people would have a lot more comfort in terms of the valuation if they could see hard numbers on that project. With respect to Westmoreland, we did 2 separate studies. The second one was honestly more of a PFS level kind of report. It's 300 pages long. Like that's essentially what we're going to build.
Right. Yeah. Okay. And with that, Mark, I think we'll leave it here and move on to our next presenter. Thank you very much for your time.
Thanks again, everybody.
So up next we have Jeff Klenda, from Chairman, President, and CEO of UR Energy. Jeff, over to you.
Okay, great. Thanks so much, Derek. Appreciate the platform to tell our story this morning. And ladies and gentlemen, I am Jeff Klenda. I'm the chairman of the board and the original founder of the company back in 2004. We marked 16 years as a company just at the end of last month. What you're looking at on the first slide, the cover of our presentation this morning, is the interior of our plant. And what that represents is the state-of-the-art ISR facility anywhere in the world. And what you see on the right-hand side of that slide is our finished product. We put yellow cake into approximately 875-pound drums. They go over to the conversion facility, and at our takeaway price, which has been roughly $50 a pound, they go out there at about $44,000 per barrel, and so that is our finished product. I won't go through the disclaimer other than to say that I will be making some forward-looking statements, but I'll try and point them out as I go through them. I have a lot of slides to cover, so I do move pretty quickly. You'll have to forgive me for that. But here's a slide that covers our company at a glance. And what you'll notice is some highlighted lines, and that's because in each area and on various slides, I do have takeaways that I'd like the audience to be able to take away from each slide. And so when you take a look at our project, we are a true greenfields through to development through to production project. We started out 12 years ago as a permitting and licensing story. After nearly 7 years, we got our license to mine and ability to move forward. And so we built out our mine in 9 months, on time, on budget, spent a couple of months in commissioning, and finally started production in August of 2013. So we are approaching now 7 years of production. But the thing that I think is most notable during that time is that we have emerged as the lowest cost producer anywhere in the world outside of Kazakhstan. But what makes us unique as a company is that starting in 2010, right on through to 2014, in what I would refer to as the last contracting cycle, we did a good job of putting forward contracts in place. And keep in mind, this was before we started production in 2013. So we spent the 2-3 years before that time putting good long-term contracts in place. Our first contracts were at nearly $65 a pound takeaway all the way through to 16. And then we got into 14 and 15 and decided we really needed to extend those contracts through to the end of the decade. So those contracts have served us very well. And now we are coming to the end of that contracting cycle. And we and others like Cameco need to make sure that we have new contracts in place. And that's what we're looking for right now. As the price is rising, we'll be looking to layer in new contracts that take us through the 2020 decade. But it's been a rough go, as Mark pointed out. We really had a watershed event in March of 2011, and that was the Fukushima tsunami, which knocked out the Fukushima Daiichi reactors there on the coast of Japan, and as a result, they shut down all of their production. But since that time, it's been very challenging. We've faced a time of really excess production and excess inventory and reduced demand. But one of the things that we have done is that, again, we've been served very well by our long-term contracts, and we have gone to great lengths to keep our operational staff on hand and ready to ramp up the plant and go back into full production at any time. And I know that Marcelo covered off on supply demand, but I'd like to make a couple of points, and that is that from the demand side of the equation, I think it's important to understand that we are still a growth industry. We have 54 reactors under construction globally right now. More than half of those will come into production over the course of the next 2 years. So we're very much a growth story, and this demand is going to be increasing sharply. And it's also important to note that Cameco, the largest player in the world outside of Kazakhstan, is also an active buyer in the market right now. But the real story that's been taking place has been in the supply destruction that has occurred really over the last 30 days, and where we have seen both uranium production and conversion shut in. And now this is not new. We saw this in 2018 and 19, where we lost about 30 million pounds of global primary production. But importantly, and it's important to emphasize, over the last 30 days, we have seen shut in 46 million pounds, which constitutes about 35% of global primary production. 7 out of the 10 largest production facilities in the world are now shut in and will be for the foreseeable future. And something that I would emphasize is highlighted there in yellow. For the first time since the beginning of the nuclear age, we have in North America, United States, and Canada, we are neither producing uranium nor are we converting uranium for enrichment for the first time since the beginning of the atomic age in the 1940s. That is a significant occurrence. Here, what you're looking at in this very colorful slide is something that we have been very fearful of for a long time, and that is that the United States has the largest fleet of nuclear reactors in the world, with 98 reactors up and running. But yet we have watched our uranium production decline consistently. This is the last 20 years of uranium production. And we have now gotten to the point where you can see we only produced 175,000 pounds last year in a country that consumes upwards of 50 million pounds a year. And this year, our production will be negligible. So we have finally, our worst fears have come true. We have gotten down to the point where we are virtually at zero production. We are just basically on care and maintenance at our plant, flowing it so that we continue to keep all operations moving. But we're one of only 2 remaining producers left in the United States. We are now officially 100% dependent on foreign countries for our uranium supply. And that's why you see so much activity at the federal level here in the United States. As Mark mentioned, about 2.5 years ago, we filed a Section 232 trade action with the federal government, with the Department of Commerce, seeking a quota that would at least protect the domestic producers here in the United States. We provide it to the Russians under the Russian suspension agreement, but on July 12th of last year, President Trump decided that he would take no action on the Section 232, but rather form what Mark referred to as the Nuclear Fuel Working Group, which is to assess the viability of the entire fuel cycle in the United States. This final report has actually been sitting on Larry Kudlow's desk at the White House since November. But obviously, with the impeachment proceedings and now with COVID-19, obviously other things have moved to the forefront, and so we are still waiting an outcome there. But we did get a line item budget inclusion of $150 million per year for a 10-year period of time. We believe that will survive the appropriations and budgeting process. And so it's not everything that we need to resurrect the industry in the United States, but it's an important first step. Just as important right now is the Russian suspension agreement. This has been in place as a result of a trade action since 1992, but it's coming to an end at the end of this year. This has given the Russians roughly 20% of our consumption here in the United States. And so right now there's a battle raging right now that will determine how much we're going to allow the Russians to continue to pour into our market and supply our U.S. utilities. The reality is that right now we have put ourselves not only in a position where we are 100% dependent on foreign sources for uranium, but we are more than 50% reliant on Russia, Kazakhstan, and Uzbekistan, which can very nicely be referred to as geostrategic rivals here in the United States. That this is something that not only is very poor energy policy, but it's downright dangerous national security policy. But then in addition to that, you've got the Iran sanctions. Now, we have been keeping waivers in place, which have allowed the Russians to continue to provide them advice, materials, and components for their growing nuclear power program. Unfortunately, they're also growing their supply of fissionable material, and it is thought that they will have enough fissionable material for their first nuclear weapon by the end of this month. So this is something that's coming to a head, and it's important to understand that these are all unique to the United States. So this is something that we are very in tune to, we're very well engaged in, but we believe that this is going to result in actions that are going to require us to ramp up as a company. Our flagship property is Lost Creek. We have been running it now, as I said, for nearly 7 years, and it has just turned into a beast. You can see from the bar chart there that going back to 2011, since Fukushima, that we have more than tripled the resource there at Lost Creek, while we have been producing and delivering nearly 3 million pounds. The rest of the pounds we delivered were pounds that we purchased in the marketplace. But what's been truly extraordinary about Lost Creek is that our recovery rate has exceeded 92%. We projected 80% in our PEA. And so to recover 92% is just unheard of in our industry. So this is a beast of a project, and one that we believe has a tremendous amount of scalability. We assess our projects. We have 12 projects total, but we focus primarily on three of them, our three largest: Lost Creek, Shirley Basin, and Lost Soldier. Combined, we have more than 40 million projects that are ready to go into production. We believe that we can, these are not just counting pounds in the ground. These are all projects that we can produce, and we can produce in the very near term. And as a matter of fact, one of the things that we've modeled here in this bar chart, you can see that we would expect that we would be able to ramp Lost Creek to 1 million pounds per year run rate and do it in about a 6 to 9 month period of time to achieve that run rate once again. In the second year, we would be able to climb to 2 million pounds a year at our Shirley Basin facility. And so we stand ready to ramp up. I think that it's important. We know that we've modeled this extensively, and our third project would come online, but that wouldn't be until approximately the fourth or fifth year. But the thing is that we believe that there will be demand for U.S. produced uranium. Not only that, but our supplies and our inventories here in the United States are running dangerously low. This is something that the Department of Defense and Department of Energy are acutely aware of. And so this is something that we believe that we will be called upon to produce and to ramp up production very quickly. And we stand ready to do so, having kept our operational staff at the ready and ready to ramp up at Lost Creek. But this is what really sets us apart from other players in the industry. One of the things that we have modeled extensively has been our cost to ramp up production. You know, I see a lot of hedge funds, and when I go in and I see the hedge funds, the smart ones ask me, as before I ever walk out of the room, what am I overlooking? What's the question I'm not asking? Well, the question that's not being asked right now is that there's a number of companies purporting to be able to produce in the United States, but no one is asking the question, what is the CapEx to get into a reasonable level of production? And as you can see here with Lost Creek, to ramp to 1 million to 1.25 million pounds per year will take me less than a year and cost me approximately $15 million. In the second year, to ramp to another 1 million pounds per year, I will have to build a satellite facility at Shirley Basin, but that will come in at roughly 26 million pounds. So for approximately 40 million pounds over a 2-year period of time, I can ramp to a 2 million pound per year production rate. And I believe that that represents a rate that is faster and at lower cost than anybody else can do it in the industry. And when I say by lower cost, I mean by a long shot. Since Fukushima, one of the things that I think is critical is how much have other companies and how much have we ourselves had to dilute our shareholders during that period of time. I don't mind telling you I'm the largest shareholder in this company. I have about 2.5% of the company. But unlike virtually all of my peers, I bought and paid for every share I have. I'm the gatekeeper when it comes to dilution in this company. I have about $3.5 million of my own money in the company. And as you can see, we have diluted ourselves far less than any of our contemporaries since Fukushima occurred. As a matter of fact, since Fukushima, which occurred more than 9 years ago now, we've only raised right at $22 million in the equity market. So we have been able to survive with the revenues generated from our contracts, and we still are delivering into those contracts this year. So we don't see the need for extensive dilution. Here is a summary of share capital and cash position of the company. We came into the year with nearly $8 million in cash. Right now, that number is about $6.5 million. We have 160 million shares issued and outstanding. Most of the rest of the diluted shares are in the form of options or RSUs that have been issued to our key insiders over a number of years, but very few of those end up getting exercised, or at least they haven't in the years gone by. We've been growing our inventories. Right now, that inventory has actually grown from 268,000 pounds to approximately 280,000 pounds. And we also have revenues coming in from the remaining contracts that we're delivering into this year. As you can see, we're well covered. That's a 2-year chart that you're looking at. And, you know, V-shaped recovery indeed. I mean, we got pounded down with everybody else as a result of the COVID sell-off last month in March. And you can see that we've come back 100% since hitting our lows. So We think that we are in the strongest position of anybody else out there in the marketplace, and we've been able to maintain that strength without having to dilute our shareholders. So we're in very strong position, and we will continue to advance our projects forward. What you're looking at here has been our production in the marketplace, and as you can see, we're in a position here where this is the resource slide once again, wrong one. I'm afraid it got replaced out, but one of the things that I will point out is that we have been in production for 7 years now. When we were producing at our highest level, which was a little over 700,000 pounds in 2015, we got our cash costs down to $16.27 per pound. We believe, now this is a forward-looking statement, that if we have the incentive to ramp to 1 million pounds per year at Lost Creek, that we can actually bring that cash cost down to under $12 per pound with all-in costs of well under $25 a pound, right at around $22, $23 a pound. Shirley Basin should be very similar, and perhaps with even lower cost, because it's about 4 times the grade. So we're very confident in what we're capable of doing. Last year, we had a great year. We delivered 665,000 pounds at an average price of about $49 a pound. The cost for those pounds was a little over $26 a pound. So we were able to scrape that delta. That resulted in over $12 million in gross profit for the company. And unique to our company is that we have been actually cash flow positive for 3 of the last 4 years. I think as investors, what I wanted to put forward here was what we see as catalysts in the marketplace. Not only are we seeing the associations that comment on our marketplace, World Nuclear Association, Nuclear Energy Institute, both profiling higher costs in the nearer term. But in addition to that, remember, we are a growth industry. We are seeing a rise in demand and just a crushing fall in supply. So we think that these supply-demand fundamentals will reassert themselves in the market, and that they will happen in the very near term. And don't forget, we've got the small modular reactors and the micro reactors that are going to be hitting the marketplace in a big way middle of this decade. And again, we saw 46 million pounds come out of the market. So the pandemic, as you move into current market forces, the pandemic-related closures are upwards of 35% of global primary production. This is making sure that we are consuming rapidly above ground inventories. Cameco's in the market as a buyer, and the working group has put officially relief for the domestic industry in the 2021 fiscal year budget. And so in addition to that, we believe that the Russian suspension agreement, we know that the Department of Commerce is right now predisposed to seeing less material coming in from Russia and more production coming from the domestic uranium producers ourselves. And so this is something that they consider to be an imperative. These things will all play out before the end of this year. So this is going to be a very, very pivotal year very much a pivotal year for us. The geopolitical risks are always with us, but with the Iranians ramping up their enrichment capability and accumulating their fissionable material, this is something that we're going to have to watch. The Iranian sanctions could result in a halt of Russian material coming into the marketplace. The United States is facing a number of conflicts around the globe. Most of them have now quieted because of COVID-19, but we are once again very heavily, and in this case, 100% dependent on foreign sources of material coming into the United States. So again, we're in a position where something must be done about this. But here are the takeaways that I'd like to leave you with today. I think that we are in the strongest position. We've given ourselves the best runway in the industry. I can go all the way through to June of next year without having to raise any money. We came into the year with cash. We have inventory on hand that we can sell into the market, and we have current revenues. But in addition to that, we have those inventories we will be selling into the market, but we continue to have our cash flow from the deliveries that we're making into the market at the present time. And I think that I would finish with this thought. This is that critical question, and that is, When you take a look at anybody who would purportedly ramp up and provide market to the domestic market here in the United States, we can do it faster, we can do it at lower cost, and we can do it at less dilution than any of our peers in the industry. I know every other player out there, and there's no one that can say they can do it any faster or at any lower cost. And more importantly, we'll do it at less dilution to our shareholders. And I think that that is one of the most important factors. So with that, Derek, I'll open it up to any questions that there may be.
Sure. Maybe we'll start with a simple one, because you are delivering into contracts now. What have your conversations been like with utilities on sort of new long-term agreements? Do they seem eager to sign on the bottom line, or is there still that urge to not come up to a price that you're comfortable
No,
with?
as a matter of fact, I think that Marcelo actually said this right from the outset, and he was spot on with it. The utilities have chosen to really erode their own internal inventories, rather than buying in the market when it was flatlined in the mid-20s. I'm not sure how you explain that, but what we have seen since the beginning of the year is that I've fielded 4 requests for proposals from utilities since January 1. I've responded to each of them. They're not quite yet at prices where we would be willing to fill contracts, because those contracts are being filled in the mid-30s. We need contracts that are higher than that. I mean, the average cost of production globally is upwards of $50 a pound. So we need contracts that are closer to that price line. But we do think that the United States will begin rebuilding its own inventory. So even if the utilities don't come across with contracts themselves, we think that the United States government will be a buyer in the very near term.
Right, and that strategic reserve is part of the Nuclear Fuel Working Group initiative, and would be, at $30 a pound, would be more uranium than's produced both secondary and primary supply in the U.S. In recent past on an annual basis. So it could be a significant lift to the domestic space. Have you, what other support for the mining industry have you heard that might be coming in that Nuclear Fuel Working Group report?
Well, we've been a bit frustrated waiting for the report to come out, right when we were told by new Energy Secretary Dan Burlett that when he was testifying in front of the Senate Energy Committee that it would be out within days. Unfortunately, the lockdown also started within days after that. So on a back burner. And so we've been frustrated by that. But one of the things that we hope that will come out of the working group will be short-term relief in the form of purchasing the inventories of the only 2 remaining producers left in the United States, ourselves and Energy Fuels, at higher than current market prices. That would serve to immediately bolster the federal government's inventory and reserves that have been, we've been living off of Cold War reserves in the United States and inventories for the last several decades. So to buy our inventories immediately would immediately bolster those inventories, and it would give us short-term relief. So we think that's one of the things that will come out of there. There's a number of other things on the table. We made our own recommendations to the working group, and that could be along the lines of tax credits. There's a variety of different things that could happen, or even longer term purchases from Department of Energy or from Department of Defense.
Okay. And then maybe talk a little bit about, we actually talked about this a little bit before the webinar started, but the question on the line about the potential infrastructure spending in the U.S. and how that might benefit the nuclear industry. What have you been hearing on that?
Well, what we've been hearing on that is that, as you know, right now this stimulus package, if you want to call it that, is coming in phases. And we were able to secure loans that turned into grants under the SBA PPP program, the Payroll Protection Program. So that was nearly $1 million. And we were very grateful to get that. And that extended our runway and keeping our critical operational staff on hand. We know that there are ongoing negotiations right now taking place between energy and defense, and that they deal specifically with energy and energy infrastructure. Now, those are closed door meetings. We do not know what may or may not come out of those meetings, but we know that it has been put forward that the appropriations that came out of the working group for the next 10 years be brought forward immediately as part of the stimulus package. So I think the way the Department of Commerce, Energy, and Defense are looking at this is that what is the minimum level of infrastructure are you comfortable with in the United States to sustain the fuel cycle in the U.S.? If we lose the fuel cycle, we lose our seat at the nuclear table. We simply cannot allow that to happen. So I think that there is a very real concern on the part of this administration to make sure that the fuel cycle remains intact, that we keep that seat at the table, and we'll be right in the thick of it as one of the lowest cost producers.
Right. Yeah, and I guess that's the opportunity that UR Energy is very quick back to market when the opportunity comes. And looking out at the uranium market, the opportunity is coming, whether it's domestic incentives for U.S. producers or just the general price moving to a place where the economics make sense for everybody. That's our view. So thank you very much, Jeff, for your time, and I think we'll cut the questions off there. I want to thank everybody for their participation today, all the presenters and the audience. A little bit of a longer webinar, but had a good audience throughout. So appreciate everyone's participation. Quickly on the poll question, which was what is the current state of your uranium investments? 76% are long-suffering uranium shareholders like myself, have been long for a while. 14% have timed the market well and just started buying uranium equities. 5% are looking at it but haven't bought yet, and 2% aren't planning to invest. So hopefully this webinar changed their mind. With that, I think we'll close it off here. Our next webinar is 9 a.m. tomorrow with SolGold, and then on Thursday, April 23rd at 2 p.m. Eastern, we're having part 2 of our uranium virtual conference with our Athabasca focused companies. And for all our upcoming webinars, please go to our Red Cloud Media page. Josh will put up the link. Thank you very much. Stay safe, and we'll see you tomorrow.